I'm Debbie Lariviere with Middleton Elite Coaching, and I have the amazing Barry Horvath from Tampa, Florida with us. He is going to talk to us about all of the creating financing that we can offer our buyers to get them into homes. Barry is with the mortgage firm Trinity and also has a title company named Dynamic Title. I told him I thought it was named after me. I think he's still warming up to the idea. I'm going to turn it over to Barry here in just a minute to introduce himself and share some of those winning strategic financial options for our clients. And as many of you know, the financial side of buying homes is no longer rainbows and unicorns. However, we're going to learn how to win in this market. So Barry, introduce us.
Hey, Debbie, thanks for having me on today, and thanks for that great introduction. You know, I'm going to let you get away with saying you were the dynamic person, and we named our title company after you because you said I was amazing. You had me then, so whatever you need now, I'm here for it. So all good. My name is Barry Horvath, and yes, like Debbie said, I am with the mortgage firm Trinity and Dynamic Title, and I'm here to hopefully offer you some insight on what's going on in this crazy market. You know, and it's happening everywhere, not just in Tampa, Florida, but I'm sure whatever market you're in, it's going to be happening there too. So I've been in the mortgage industry like 24 years. I had to think about how that was. So I started at a very young age, as you can see. I had no gray hair when I entered into this industry. And I am fully aware of what our real estate professionals and partners go through on a day-to-day basis, trying to get a loan to closing or get people qualified. So I encourage you all to get partnered up with somebody in your community or somebody you trust, because, you know, we talk about, you know, I know you all love iBuyers in the real estate world. And we all love people who apply online for their next finance option. So we're kind of in the same boat together. You need somebody to help guide and navigate you through what's going on out there. So Debbie, in your market up there, every one of your appraisals are coming in exactly on value, right?
Oh, of course, Barry. We're never arguing appraisals. I mean, the market hasn't risen in price, I don't know, since yesterday. So yes, as you could imagine, appraisal appeals and appraisals not coming in is a consistent battle that we're facing. You know, as the market cools a little bit, I still think we're going to run into that as sellers are working to gain even that 5 to 7 to 10% appreciation. So definitely something we're challenged with.
Yeah, so appraisals are you know, more common because obviously less inventory, more demand, sellers can command a higher price, so they're going to try and get it. So appraisals are coming in short. It's great when you have a cash buyer, nobody worries, right? But when you don't have a cash buyer, we need that appraisal to come in. So one of the creative things we are doing in this market is when, you know, part of the negotiations, maybe the appraisal comes in a little short, and instead of lowering the purchase price on that property, let's just give a hypothetical example here. Let's say you're buying a house for, say, $350,000 purchase price, which I know is maybe on the low side in this market, but in some markets that's below the median price. If a buyer were putting 20% down, they'd have a $280,000 loan. The interest rate, and this is hypothetical, so, you know, we all know interest rates are depending on loan to value, zip code, credit score, all of these different factors, but a rough safe number is around 6.625. And I tell people, they're like, rates are so high, right? Well, if you had that scenario, your payment would be somewhere around $1,793 a month on principal and interest. So let's just pretend the appraisal came in short, and instead of just dropping that price down on that property, that 10 grand, because the appraisal was short 10 grand, we would save our buyer somewhere around $60 a month, okay, if we lowered that purchase price with that same interest rate. Why don't we take that same money and buy down that interest rate? If you buy down that interest rate, I can tell you probably based, and again, every scenario is different, you'd probably get an interest rate somewhere in the upper fours. 4.75 is what I just recently saw. So that 10 grand would lower that same payment down to about $1,461 a month in principal and interest. That's about a $332 a month savings just by taking that 10 grand and moving where we're putting it. So, and maybe even when you're entering into a contract, consider that. I know this is unheard of, but sellers are now giving concessions again.
Yes, yes, they are. They're
rumor.
helping with the buy down. They want to sell the house before the market crumbles, right, Barry?
Yeah, because we are in a crumbling market. We are not. I love, what? When people get up on Facebook and rant, I can't wait for this market to collapse. Look, the sky's falling because interest rates went up. That is the furthest from the truth. I mean, I know it's basic economics for most people, but Debbie, I think you just shared with me in your market, you had 0.7 months worth of inventory on the market. Okay. And in a moderate appreciation market, history tells us, and I don't make this stuff up, this is just history, 6 months of inventory will give you moderate appreciation. Okay. Now, are we going to see rapid double digit, 30-40% gains year over year right now? Probably not. Is inventory going to level out? But the sky is not falling when you have 0.7 months worth of inventory. It's supply and demand. The more inventory you have and more buyers, the market can't collapse. And I could go on and on. This market is different. People say, oh, it's just like 2008, 2009. It is nothing like 2008 and 2009. There are, so many differences today. There's so many safeguards in place today that weren't there in 08 and 09. I'll give you an example. In the state of Florida in 2010, we had 95,000 mortgage brokers. When the market collapsed, guess how many there were? 5,000. 5,000. I was one of them, okay? I'm proud to say I'm a survivor in that market. Well, because what happened was the regulators came in and said, we can't have another meltdown like we did back then. We got to put safeguards in place. Do you know that I could hire anybody off the street and make them a loan officer today?
Wow.
They didn't need to be licensed. They were not accountable. We had no NMLS numbers that tied any loan or housing to us. It's fully regulated now. We used to be able to call up appraisers and say, hey, Deb, listen, I need this property. Yeah, they're buying it for like $350,000. Can you get it in? Can you bring the value in for me, Mr. Appraiser? Sorry, Mary, I can't do it. So what do? You pick up the phone, you call the next appraiser. Bill, I need $350 on this house. Can you get this in? Yeah, I think I can do it for you. Hang up the phone, the appraisal would come in. That's what that market was. When Dodd-Frank Act came into place, none of those things were allowed anymore. The Appraisal Act came in. We don't even get to talk to the appraisers anymore. Now they go on a rotation list with an AMC. A random appraiser is picked. We're not even allowed to talk to them and say, beef up the price. So this is nothing like that time frame. And there were also loans, Deb, I know we're going to talk about ARMs too, right?
Yes, absolutely.
So, and that may be an option for people right now who don't like interest rates. We'll talk more about it. But let me tell you the difference between ARMs of today and the ARMs back in the, let's call it, what do you want to call that? The dark ages in the mid-2000s?
No, those were the fun times. That's when I was selling property actually in Orlando, believe it or not. And I have this vivid memory of I had, much like we have recently, where you get the 27 offers and you walk in and the sellers are like, oh, I don't have time to go through all those. So you throw it in the air and you catch one, and that's the one you take because they were all great. And we just kept rolling.
Well, we called it the Wild Wild West, right?
It was.
So during that time when I had loan officers working for me who weren't regulated, weren't licensed, no training, no continuing education, they were doing arms called 228s and 327s.
Right.
If you know what they were back then, those arms were literally fixed for 2 years. You could be one day out of bankruptcy. You could do stated income. If you could put fog on a mirror, Deb, you were getting that loan. If you were at a low paying job, you could buy 6 rental properties and we would approve them. That's the way it was. You can't do that anymore. Dodd-Frank came in and said the borrower must prove the ability to repay. So I don't make those rules up. I just have to go with them. But it's so different now than then. Now, the 228s were fixed for a period of 2 years. That's why they call them 228s. 327s were fixed for a period of 3 years. Those were the subprime loans. Wall Street was greedy. Wall Street was just taking that money and running with it. Those arms would be at a start rate of, say, 7.99. That guy that had the low paying job and did stated income, we put him in that arm. He would be able to buy a house, probably close in 2 to 3 days, mind you. And that arm would stay fixed at that payment for 2 years. And guess what the floor rate was? 7.99. Guess what the market did? Rates went up, right? We started to see no equity in homes. We have equity in our homes today. Pretty much everybody does right now. There was no equity. Their renter all of a sudden couldn't afford to pay them. They miss a payment. Boom, it's like a house of cards. Their payment went up from $800-900 a month to $1,200 or $1,300 on those arms. There was nothing they could do about it. They couldn't refinance to get out of it because they had no equity. So it was a house of cards. This is not the same market as we had back in the late 2000s, mid 2000s. It's totally, totally different. So
Tell me, since we're talking about arms, what does it look like now as far as a strategic or creative financing option for buyers today that are probably, if they were in it gun shy from then, but now need to know, when their lender says an arm, they can be educated, or our real estate agents can educate them on what that is.
It's so funny. The arms from back then to the arms today, those arms were actually available through Fannie Mae and Freddie Mac, but nobody did them because they were more work. And for whatever reason, the credit criteria was different. Underwriting guidelines were different. The arms of today are probably, give or take, a point or so lower in rate than 30-year on, customary loan. So payment savings can be great for that. But the arms of today are more on a fixed margin. So you'd get a 5-year arm or a 7-year arm. Perfect for somebody who thinks, you know what, I'm only going to be in this housing for probably 3 to 5 years. The kids are going to be moving out. We're going to downsize. It's a great option for them. Or my job is going to probably relocate me in the next couple of years. Why not enjoy that lower payment savings now? And even if you bust that arm on today's arms, they're on a margin. They're on a base plus a margin tied to an index. That index are very, what I'm going to call them comfortable indexes, okay? And the margin is fixed. So it may go up a little, it may go down. It can actually go down if the market cooperates. So the arms of today are way better than those old 227s and 328s that we saw back then.
Yeah. And like you said, the savings there are phenomenal. And what we know too about the market is every market has a cycle, right? Just like the interest rates have a cycle. So if you thought about taking the opportunity within a 7-year arm, you could potentially predict that would be the real estate market would be running its course through a cycle, much like interest rates. So you could potentially come out on the other side at 7 years, refi into something a little bit lower, or selling your house a little bit higher, because we've seen gradual or standard appreciation across the board over the last 7 years. So that to me is just, it's a definite value, and that it's not this big, huge, here's your balloon to your
No.
birthday.
Yeah, it's not, they're not gonna bust. You know what's so funny? The 227s and the 328s in the subprime days have prepayment penalties. The ARMs of today, sold through Fannie and Freddie, typically don't have any prepayment.
Oh, well.
And you know how long, you know what's so funny? They would lock you in on those old subprime ARMs for how long they were fixed for on the prepayment penalty. So if you had a 228 ARM, the penalty was for 2 years. You could never get out of it. They had you handcuffed literally to that. The ARMs today have no prepayment. So if interest rates come down, you can refinance, like you said, if, when the market comes down a little bit. Are we going to get back down into 2s and 3s? I don't see it right now, not short time, not the way inflation is right now. It's just not going to happen. Are we more likely to hit the 7s than we are the 2s or 3s? I would say absolutely. But you know what? If I were in the real estate business selling homes, I know from the lending side and title side, our best years were that decade of interest rates were between 7 and 8%. Believe it or not, because we have plenty of inventory. People are moving and buying and selling houses all the time.
Right.
And it's just the facts of life. That's the way it works. That was a comfortable time. And as long as people qualify, why not? And if they want to go into a 5-year ARM or 7-year ARM, maybe they'll qualify for more purchasing power as well.
Mm-hmm. Yeah, and I bought my first home, my husband and I did, and we paid 8.25 was our interest rate. I've gone back to look at the old stuff just to see. So, we wanted a home, we bought it. And I think too, we're entering into that area where people know or are familiar with that 2.5 to 3.5 to 4, like that climbing interest rate. But if they didn't purchase a home or refinance in that time frame, they don't really understand how that impacts what they're buying now, and they're still going to buy homes. So,
well, sure. People are buying and selling real estate every day, but an ARM might be a great option to consider. And because, if you've got a buyer out there looking at a $400,000, that's their max payment, maybe they'll qualify for 25, for 30, I don't know, just, it all depends. So.
And I think that brings up a really good point, Barry, because many of our buyers that we've been working have been buyers that we've worked over the last 12 months, where they have been multiple offers, can't get in something, still looking, still out there. Maybe they've decided to hop back off the fence because there are fewer offers going in on properties right now. And when they're getting requalified, they're realizing that when they got that first pre-qual, it was based on 3.25 and they could afford 500,000. And now based on today's rates, we've had to back that down. Now they don't like what they see at 425. Right. And that's where that ARM could, like you said, maybe bump them up to 450, 460, get them somewhere to where they're finding what they want. So I think that's a really valuable thing.
The ARM can give them more leverage to buy more. And one of the things that, I work with a lot of great real estate professionals out there, and people need to understand that, they say, well, what's their maximum purchase price? Well, it depends, because every lender qualifies people on a max payment, not a max purchase price. So we have to guess at the taxes, we have to guess at the insurance, we have to, if there's an HOA, we have to factor that in. So all of those things, play in. So if you know exactly what the property taxes are, if you know what the HOA is, and if you got an insurance quote, you can get a better idea. And of course, interest rates change like the wind. So if you don't like them this morning, wait a minute. And it's so funny, my phone rings off the hook every time the Fed meets, and they're like, they raised interest rates today 0.75%. What's that mean to me? Nothing. It means your credit card probably went up. It doesn't mean your mortgage rate went up, because mortgage rates are tied to the 30-year, to the bond market. It has nothing to do with the Fed short-term rates. But man, we could go on and on. You got me rolling now, Debbie.
Roll us on to the next topic here. I know we have a few more that we'd like to talk about.
Yeah, so I know we wanted to talk a little bit about jumbos and combos. And again, it's all about kind of be creative, because sometimes maybe you have a buyer that's looking to buy in the jumbo market. But I have to tell you, the guidelines for qualifying for a jumbo are much more stringent than a conventional loan. Hear me out again. The guidelines for qualifying for a jumbo are much more stringent. Instead of getting 2 years tax returns, you might need 3. Okay. You're probably going to wind up in an arm in a jumbo, because Fannie Mae and Freddie Mac do not purchase jumbos traditionally. They're kept in-house at banks, their portfolio typically. So you may wind up with an arm. So the interest rate is probably going to be a little higher than conventional. Credit score requirements could be a little more stringent, because let's face it, it's all risk-based pricing. If you're buying a $1 million house versus a $500,000 house, it's a bigger risk to the lender, the end investor. So a prudent strategy may be to do what we call a combo loan and I'm not saying don't do a jumbo, but you could take a first loan, whatever market you're in, because jumbo limits are different by zip code. So whatever market you're in, let's say it's $600,000 is your max for conventional. If someone's buying $1 million property and they only have $200,000 to put down, you're going to be in jumbo. Maybe you do a secondary loan, like a HELOC or a second loan, piggyback it with a first loan, and now you may have 2 loans, but I promise you probably could have a lower monthly payment for your buyer. And it'll also maybe help them qualify for it and avoid, maybe the guidelines that are more stringent for qualifying for that jumbo loan.
Yeah, great information. And again, not all of our clients work with people that are at that jumbo price point based on area. And at the same time, we need to be educated enough when our buyer comes to us and says, hey, the lender said I should take a jumbo, to at least look at the other options and make sure that that's truly a good fit. And if it is, great. Like you said, it's all about being comfortable in the monthly payment, more so than the cost of the car or cost of the house. And I was about to say, because we look at cars, we don't go to the Tesla dealership and say, oh, I'm buying a car for $200,000. We go to the Tesla dealership. Is that
what Teslas are up there? 200.
I guess. I don't own one. I have an old Suburban, so we got the family car. They look great. The Teslas look great. But again, they're looking at the monthly payment. What is the monthly payment costing me? And I think that's how we need to look at housing as well.
Absolutely. It's I always say to people, I get people looking at manufactured housing right now. Mm-hmm. The interest rates are higher. Okay. The insurance cost is higher, but they go up on one of those iBuyer sites that we won't talk about. And all they see is the purchase price. And they're like, oh, I can afford that. It's only $250,000. Okay. But when we look at the whole payment, they're paying a point higher because it's a manufactured home. And I don't know about in your market, but it's not pretty right now in Florida for insurance. So manufactured housing, the insurance rate's going to be higher. So I say to them, okay, this may be a great option for you, but do you want the lowest purchase price or the lowest payment? Well, Barry, I want the lowest payment. Well, maybe we should look at this single family next door. So, and have a more, and I'm not against manufactured housing, but let's face it, you're probably going to get more appreciation out of a single family home than a manufactured home. The land is typically what appreciates.
Well, and you're right too, because we see that with condos and townhomes, and you pinged on this a little bit earlier about the HOA fees now are layered into, on top of taxes, insurance, HOA fees. And so you could have the same buyer that could afford a single family at this price or the condo at that price, because there's a $300 a month HOA payment tacked onto the bottom of it. So again, it all comes down to value and obviously lifestyle that they want to lead, and monthly payment and that sort of thing. We're just here to help them be strategic and win their buyers getting actually into homes right now.
Absolutely. Because when they go on Zillow and sorry, did I say that? I didn't mean to mention anybody. But when they go online, whoever they chat with is going to know exactly what they need in that market because they understand it, right? They live there, they breathe there. No, you better partner up with somebody local who knows their market and lives there, knows what's happening, knows the best schools. There's so many factors into buying a home than just price. And but yeah, we could go on and on about that too.
Yeah.
So let's talk a little bit too about other things that may be able to help people get into a home. And I know real estate professionals, true or false, Debbie, you are self-employed, right?
I am
So-
self-employed.
Okay, I want to remind you that no one from the IRS has ever followed me or any recording I've ever done. So you are safe to say anything in this format, okay?
Perfect.
So every real estate professional, when they earn income, they claim every single dollar and never take advantage of any deductions tax-wise.
No, never. And that's why when businesses sell, the financials are clean, because there was never even just that trip to the restaurant where we talked about business with our friends taken off of our income taxes.
Which, by the way, anytime you want to expense me, we're here
I'll
for
come
you,
expense you, Barry. Yes, we'll go somewhere nice
So-
on the water over in Clearwater or something.
That's it. I'm ready for your write-off. So that's a challenge right now in the market, because earlier we spoke about Dodd-Frank. If somebody wants to pull up the law of Dodd-Frank and read it, it's the longest law you'll ever read. It was written when the market collapsed. It was to protect consumers. It was to stop another meltdown. All of these things that were happening, the appraisal acts, all these things were tied into it. But I'm going to tell you in like 3 words what it really says in this whole act. It's more than 3 words, but that's not important.
You got me excited.
Yes, I know. All Dodd-Frank really said was the borrower must prove the ability to repay. So for the real estate professionals out there that, or self-employed people, or anybody who likes to take advantage of every legal loophole that tax advantage wise the IRS offers. I have people that make $200,000 a year, and then I get their tax return and they show a net of 30. I'm like, what happened to your 200,000? Well, that's what I made. I said, yeah, but you took 170 in write-offs. So the only income we can count is that 30. Do you understand that? No, that doesn't make sense. That's the law. I'm not, we don't make the rules. That's just what it is. Whether you use my company, the bank down the street, or anybody, we all must abide by that law. So there are alternative options. There are no more stated income loans like there were in the bust, but there are loans that you can be creative with, like a bank statement loan.
Thanks.
So what does a bank statement loan do for you? I'll give it to you in a Reader's Digest version. We take 12 or 24 months of deposits, we add them up, we come up with a factor for basic expenses, and we actually count that as your income. Period, the end. So all you realtors, real estate professionals that write off everything, you still have an opportunity to buy a home. Now, are you going to get that 4.75% interest rate that we talked about earlier? No, but you're still going to get in a home and into a good loan program. It's not going to be the 227 or the 328, those subprime loans. It's still a good loan. And it may be a great option for your buyer that doesn't show all their income on their tax return, because you can't, no matter what lender you go to, every lender does a verification with the IRS.
Mhm.
They must pull a transcript of 4506 from the IRS to say, because I know this will shock you, Debbie, but people back in those wild, wild west days when you were having a good time in Orlando, like you were talking about,
Yeah.
those people actually came up with documentation that was a tax return that looked like them. We have to, every lender has to do it, has to go to the IRS now and say, yes, this tax return matches this person, and they reported to us what they said they were. There were websites called like W2.com and paystub.com that you could print your own pay stubs. All that's gone. So anyway, the bank statement program might be a great option for someone who doesn't show their income. And it's also another option for people who are 2 years out of bankruptcy,
Oh.
2 years after a short sale, 2 years after deed in lieu. So there are alternative programs out there. Get partnered up with a lender professional that can navigate your clients through all this. So there's
Look at you,
definitely
Barry.
some.
You just brought the rainbow and unicorns back to self-employed people. Yay, Barry.
I love it. I
Said
love it.
financing isn't fun or lending isn't fun. Whoever said that? I just have one question for you, Barry.
Sure.
Before we wrap up today, I know we started the top of the conversation around buy downs, and the one thing I've been thinking about as I've been listening to you today, the buy down is great while you're in the transaction, but for me, I look at it too as an opportunity for people who are looking to get qualified. If they were initially going to put down that 20% and they said, well, it's better for me to buy down the rate, and could I qualify if I put 10 or 15, so I would have that extra cash to buy down, pay over appraised value, whatever I need those funds for. I'm thinking that might be an opportunity. Would you agree?
Again, you have to weigh it out. It depends. Okay. I hate to be like sounding like a politician, but it depends, because let's just say they're putting down less than 20%. Now they're putting 15% down. Well, if you put down less than 20%, you're going to have MI or PMI insurance, which is basically a fee the lender charges to protect themselves as part of the loan. So, and it varies with credit scores. So you'd have to weigh it out in that scenario. Now, if they were putting 25% down and maybe buy down and only put 20% down, take that 5% buy down, it might make more sense. So you'd have to weigh it out, and depending on the rate, but it might make sense to look at that buy down, because the PMI rates are actually, if you have good credit score, at an 85% loan to value with 15% down, is very inexpensive. Now, on investment properties, not so much. That, that's a whole nother market. And
no, and I agree with you. I was thinking primary, and from that PMI standpoint, agreed, because that's what I was looking at recently were those PMI dollars, and very affordable. I mean, it's less than a HOA payment if you joined or moved into a condo community where you had an HOA payment. So
yes,
I just think could be some potential options
there's
there.
definitely potential, and PMI can go away. Okay.
Exactly.
So once you hit most lender docs, you have to read your note when you close, which everybody sits there at the closing table and studies that entire note. I like to educate people on what their options are ahead of time, so they don't sit there at the closing table. I like joyful closings. I don't know about you, but most of them say 2 years. After 2 years, or if you're at 79% LTV, you may have the option to remove that PMI insurance. Mm-hmm. So it depends on the servicer of that loan.
Well, I would say with that too, those of you out there who have buyers who purchased a home 2 years ago, with the amount of 2 or 3 years ago that may have had PMI, with the amount of appreciation that we've had, it might behoove you to have a reason to call them, have them research, can they get the PMI removed just by having a new appraisal, which I think then it's like 78% you have to have LTV.
It just depends on the service and on it, but 78, 79 I've seen, but it's below 80. When you get below 80, you might want to check, because that servicer may require an appraisal. They may do an in-house desktop review.
But still, you see, all I'm doing is giving them a reason to call their past clients. Like, go look, call their past clients if they didn't put 20% down, and see if you have a reason just to talk to them and bring value. So
there's something to be said about relationship with somebody who knows you, knows what's important to you, and can help you navigate in this market. But real estate is still, in my opinion, the best investment anyone can make in their life. So we all need a place to live. So you might as well buy an appreciating asset, right?
That's exactly right. Exactly right. Well, Barry, I appreciate your time today and all of your infinite wisdom for our clients and for our listeners out there. If you're in the Tampa area, give Barry a call. Take care, everyone. Thank you for joining us. Bye-bye.
Thank you.